Okay, thank you for joining us here today. We have an amazing panel here talking about stablecoins, catalyzing crypto adoption and innovation. First, I want to thank the folks from Istari, Tracy, Anthony, and your whole crew. Thank you so much for that. It's been a fantastic first panel. And we have a great panel here today. We're going to do a bit of a lightning round here in terms of our intros. We're not going to make them too long. My name is David Nage. Arca is a registered investment advisor that was started in 2018. And we currently have 3 funds at the firm. For our VC funds, we typically are investing in payments, stablecoins, DPIN, and a multitude of different things. We usually do pre-seed, seed, and A. And would love to be able to talk to you all if you are out there right now. And so we're going to go to Anthony, and then Louisa, and Zach, and then to Jack, and then we're going to go into some great questions.
Perfect. Anthony DeMartino, General Partner of Istari and CEO of Trident Digital. Trident, we do stablecoin adoption, and our largest clients, PayPal. We're here excited for the Solana launch yesterday. And I'll move it on to Louisa.
Thank you, Anthony. Louisa Bai, I'm part of Mysten Labs, the creators of the SWI blockchain, Layer 1. We just turned a year old last month. And I'm the head of stablecoins partnerships at the Labs entity. We also made a pretty cool announcement yesterday. We're partnering with Agora Finance, and we'll be the first non-EVM chain to adopt AUSD. Over to you.
Hey everyone, I'm Zach Abrams. I am the founder of Bridge, and we've built a lot of stablecoin infrastructure to enable people to move into and out of between different stablecoins. And we work with a bunch of folks from payments companies, and like the Coinbases of the world, the U.S. government, Scale.ai, to all help them use and distribute stablecoins.
Hey guys, my name is Jack. I'm CEO of Stable.com. We're launching a new stablecoin, a fiat-backed stablecoin called USD3. Yeah, if you think of what USD1 is, it's kind of like money in your bank. USD2 is money in your Cash App and Venmo. And USD3 is a stablecoin on the blockchain. And just like Web3, right, own does not negate read and write. It incorporates it. So USD3 should be interoperable with banking systems and digital wallets out there as well for more arms and legs onto smart wallets. So I was also first employee at Wire, which is a first generation on-ramp, and had a stint at Consensus with MetaMask institutional.
Awesome. So what I like to do is I like to try to figure out where we were to where we're going. Stablecoins are a new form of money. It's a new form of payments. It's a new form of global remittance around the world. And I'm a bit of a history geek, and I just like to kind of go back to the record book. So who here, I like to make it interactive, and then we're going to get into some good questions. Who here can tell me what the first money was in the world? Anybody?
Shells.
What's that?
Shells.
Shells. And then there was also the first printed money was the Mesopotamian shekel. The first known form of currency nearly 5,000 years ago. 5,000 years ago. So just think about it. Stablecoins have been on the market since around 2014 with Tether. It's only been about 9 years, and we're already talking about how stablecoins are going to completely revolutionize payments and forms of money remittances and payroll and all these things that we've been doing for hundreds and thousands of years in different ways. And so much is happening here. There's so much innovation. There's so many things. So we're going to get into some great questions here. The first question is, what are some of the most significant growth areas and use cases for stablecoins? And we'll start with you, Anthony.
Thanks for that. So obviously payments is a huge use case. We've seen a lot of talk about using for payments for merchants, for payroll, and the big one being remittances. I used to be the head of FX for emerging market FX for a couple of banks. And understanding how difficult it is to move money around the world. I think people don't recognize that there's a far fewer currencies that are deliverable, which means you can physically buy them outside the country, versus non-deliverable currencies. And also, people don't quite understand that the dollar trades against almost every currency, but countries that are adjacent to each other in most continents don't have a fluid FX market. So the dollar is truly the global currency, and stablecoins will promote payment. I think another big trend is the yield-bearing aspect of stablecoins. I think we'll come up to that later. not a huge fan of the way they're being constructed right now, but we'll talk about that as we move on. But I think those are, to me, are the two biggest trends of the space.
I mean, we love dissenting agreements and dissenting arguments, so that's fantastic, Louisa.
Well, I'm not going to disagree with you now, but what I will do is add on to what build upon the payments aspect. I do believe that is really the killer use case when it comes to stablecoins right now, even though we're seeing a lot of tremendous success with trading and within DeFi. But in order to really activate payments from a retail usage perspective, we have to abstract away the crypto and the blockchain component. And I think that's what I'm personally super excited to see and help build and help all of us get to that stage.
Awesome.
Yeah, I mean, we see a few different trends of folks who are building on top of our APIs. The biggest of which is what y'all mentioned is cross-border payments. Very, very meaningful one, especially when you can move from local currency, stablecoin, use that in lieu of SWIFT and settle back down into US dollars or euros. There is like an enormous opportunity there, but the weak point is basically liquidity, the depth of liquidity in all of these different markets. So getting in and out of local currency into stablecoin at a rate that is comparable to FX rates. The other thing is that there's just like enormous demand globally, like way up here for US dollar, and the amount of it that's met by a fiat dollar is like down here. And so there's just a lot of people that want access to dollars. So we see a huge number of folks building neobanks and other fintechs on top of stablecoins to give people in Argentina or Nigeria or the Philippines or Colombia or Brazil access to US dollars. Yep. We also see, building on a similar trend, stablecoins give people in a bunch of foreign countries the opportunity to elect to get paid in a currency other than their own. So, you're working for a gig economy company and you can normally get paid in Argentinian pesos, and now you can select via deal or whatever else to get paid out in a stablecoin. But those two things, the cross-border payments and access to dollars right now are some of the bigger drivers. I think in the future there will be also a very meaningful increase in folks who are using stablecoins purely for treasury operations, and none of us will know that it happens, but there will be many, many, many trillions of dollars just moving behind the scenes to help companies manage their funds across different markets.
Amen. Yeah, I mean, I guess I roughly think about this in terms of crypto economies versus real world economies, right? And in terms of payments, these are different subsectors of payments, whether it's cross-border payments, peer-to-peer remittance, right, international payroll, and different forms of moving money around the world that is much faster and cheaper than if you were to use a SWIFT wire transfer to, have a Chinese merchant pay a Nigerian seller and go through like a lot of nightmare on the sanction side, especially as we're moving kind of from this unipolar world to a multipolar world. All the different payment networks are not as connected as before. So you might have different factions of different variations of SWIFT and payment systems being built up by different nations in Southeast Asia. IDRs promoting dumping dollars and promoting their own currency. So, I do see more local currencies come up, and products like DFX.finance can kind of solve that on an on-chain protocol through an AMM that does FX later on. Definitely programmable money in terms of smart wallets and all the programmable flows of funds that you can do in the back office that definitely streamlines things once you actually do have multi-currency stablecoins, which is probably still 5 to 10 years out. There's a lot of teams already, right? And those teams really have to kind of work together. We have to get out of this mindset of like competition because we're trying to grow the pie together. And the geographic nodes of the issuers that are issuing different currencies outside of USD needs to really kind of work together to drive adoption, real world adoption from real world merchants, enterprises.
Awesome. And just very quickly from my side, I like to abstract away. I'm a father of 2 kids. One's 13, one's 10, and I'm seeing what the world is going to look like through their eyes. They're gamers, they're digital, they're on their phones or on their devices. They're not using hard currencies. I think I paid for some pizza and I used a $20 bill the other day, and my younger son was like, "What are you doing? Why aren't you just double-clicking your phone?" And my 13-year-old now is, he double-clicks his phone with Apple Pay, and that's how he's paying for things, and that's how they are. And so the idea is that we have to really just look to the future. We can't just look to the past. The credit card came onto the world and the scene in about the 1950s or so. And if you look, the majority of the currency that we have out there, I think about 95% or 96% of it is already digitized anyway. And so this is the way the world is moving, and the way that we see it from our perspective is that there's two things: payroll, being paid in USDC, being paid in a stable, is naturally, in our opinion, going to be the evolution. And then the second thing, as I alluded to, and we're currently in investment committee on this one right now, is global remittance, especially in areas like Africa. We're dealing with a company in South Africa that is effectively trying to help and solve the problem with SWIFT. SWIFT will charge exporters and importers 20% for their payments, and it will take them 2 weeks to be able to turn over that payment. If you're an importer or an exporter, that is incredibly suboptimal. And so this is just an area that we see just hugely, vastly improved by the use of stablecoins right now. So the second question is, and we'll start again with you, Anthony, and of course move down the dais. What are your thoughts on the emergence of new forms of stablecoins, such as Athena? So again, you and I have been in this space for a while. We've seen the algorithmic stablecoins, we've seen the fiat-backed stablecoins, we've seen the collateralized stablecoins. What are your thoughts on Athena and some of the new gen stablecoins that we're seeing?
All right, so I did a lot of work on Athena myself, and I went from originally absolutely hating it and thinking that this, as the thing gets bigger, it's just creating systemic risk, to it's going to create a small amount of systemic risk and could eventually gain escape velocity, and I'll tell you why. So right now, this morning, you could earn 36% yield taking a stablecoin, minting Athena's stablecoin, and staking it, right? They're telling you what they're doing. What they're doing is making 10%. So how do you get from 10% to 36%? The way you do it is only 20 to 25% of that USDE is staked. So they're making 10% on 3 billion and only paying it out on 700 or 800 million, right? So that's how they're getting it. There's nothing funny about that. That's how they're doing it. So the question is, how are they incentivizing $2 billion not to earn anything, right? And what I think they've innovated is basically what VCs do when they buy discounted tokens, right? They give you money to a project. That money's locked up. They have tokens in a wallet that they can't access for 2 years or 3 years, and they get them at a 50% discount to today's prices. That's what they're doing currently, whether they're doing it with big investors, and the token is ENA, their governance token, right? They're doing it with big investors or small investors via Pendle or some of these other, or giving out their own point system to keep you to not stake. Everything they're giving you that's not yield is paying you not to stake. Okay, so that's the math of it, nothing like sinister there. But eventually, that lockup period is going to end. And then the person who's supplied this capital is going to say, hey, I want 36%, or I want out. So one of two things happens. There's the drop in demand for the Athena token, the USDE, drops off precipitously, or everyone stakes and the yield drops off precipitously, which then makes people want to leave. So it really comes down to how they've managed this liquidity event, right? If 2 billion of lockup comes up on the same day in 6 months, well, that's going to be a problem, right? If it's scattered over 2 or 3 years and there's more use cases for USDE and they bought themselves more time, great. But the thing that scares me a little bit is Bybit is now accepting it as collateral. You can post it on CDB platforms. You can post it on lending platforms. This is could be a disaster in plain sight if they can't figure out how to roll people from the equity model to actually wanting to hold this token and earn a lower yield. So,
and God only knows we haven't done that before.
Well, I mean, the run-up is always great, right? Ondo somehow makes 10 basis points, but they got a token that's worth $1.3 billion, right? So don't really understand how that math works, but if you're along the token, good for you. But yeah, that's kind of, I'll just stick to the Athena topic because I don't want to piss off too many people on one comment.
Well, actually, let me pause here. Who understood how Athena works in this room? And they can fully explain it. All right, I have 1.5.
10%.
You got 3.
All right.
3 out of 50.
Great. I think that's a pretty good, that was a great explanation for what it's worth. But for me, it took me a long time to fully comprehend it, and I still don't think I fully understand it. But I think it's clear to point out that we need to define what is a stablecoin and the different categories of stablecoins. I think simplistically put, USDC, USDT, for better or for worse, are defined as one-to-one backed fiat stablecoins. There's nothing funky about it. We all understand that if we hold one USDC, we will be able to redeem that for $1 directly with Circle, assuming that the banks that they bank with don't have any issues of...
Because that hasn't happened before.
Correct. Now, what I will say about this new entrance of stablecoins, like the Athenas of the world, like Ondo USDY, like Agora AUSD, like USD3, they're trying to forecast what a world of dollar stablecoin will look like when interest rates perhaps fall. They're trying to be creative and find a place for themselves because they want to differentiate themselves from the USDCs and the USDTs of the world. I think the way that Athena has structured it sounds like it's very sophisticated and smart. I don't think I've developed enough understanding for me to say that I want to put 100K of my own money in it. But I understand other models like what Agora is trying to do and what USD3 is trying to do. I won't steal your thunder here, Jack.
No, you do.
But their ultimate goal is to share, they have a business model to share income with the platforms that partner with them. And I think that's a more sustainable business model compared to what we see today from Circle and from Tether. And it's also easier for me to comprehend and explain to a regular person of what they're trying to do versus the Athena project. But you're just smarter than me, Anthony, so.
Well, I want to make one clarification. That's totally not true. But they changed their website to go from stablecoin to synthetic money.
Athena?
Yeah, they did it in the last few weeks.
I think that's a much better description
Yeah.
of what
Well,
Athena
if you also
represents.
know anything
Austin
about
Campbell kind of beat him up a little
the
bit.
the regulators, also just to chime in there, because we have experience with this, because we actually built a backed asset called Arcoin a few years ago. The SEC and the regulators hate the word stablecoin, just as an FYI. If you're building one of those, they don't like that word. So anyway.
On our side, I mean, we build a bunch of infrastructure to move money. So most of our use cases are payments related. So we have, rounding to zero demand for algorithmic stablecoins. We have hundreds of developers building on our APIs, and maybe one or two are using DAI, and that's it. So, I mean, generally speaking, for our use cases, it's not hyper relevant, but I think generally for the stablecoin space, like while I don't know the ins and outs of how the stablecoin works, it is, we're so early that like it's good to see so long as it does not like destroy the space, experimentation. And even with like Terra Luna and a bunch of the other USDC depegging and what have you, people like the space is going to naturally go through cycles where a bunch of people try some things, they're going to fail, the new generation of people will learn from it, and it'll help us get better and more resilient over time. So I'm excited to see like all of the different stablecoins that people are trying and the different variations, and some will win and some won't, but I think over the long arc of time, it will make the space significantly more resilient.
Amen. Yeah, I mean, the thing is there's just different target audience out there, right? Like if you have MakerDAO on ETH, but now you have Bucket on Solana, it's the same protocol, but underlying asset is not ETH, is Sol. And there are a different type of user base for that wants to use that, right? Systemic risk aside, which I hope that USDE is not the next UST. There's just an eclectic collection of different types of stablecoins for different type of usage and different type of audience, right? Specifically for payments, I'm glad that they're not calling it stablecoin anymore. Some kind of synthetic money market token makes much more sense. But yeah, for like payments, I think that it makes a lot of sense for it to just be a fiat-backed stablecoin, because you're gonna have to move the money off chain into the real world anyways. So you're gonna be dealing in fiat treasuries. You're gonna have to deal with the local payment networks and banking networks. So, I think from a risk standpoint, though, the risk parameter of all of these things is different, whether it's, smart contract risk or tokenomics risk, right? Or, custody risk and, government collapse risk, if you will, with, T-bills and hyperinflation in the macro sense, right? So whatever in depeg in USDC when SVB collapses. So risk parameters for all of these things exist. Do your own research and just understand why you're using this and what you're using. Yeah.
Yep. And as I said, stablecoins have been around for about 9 years, and so you're talking about fiat-backed, you're talking about collateralized, and you're talking about algorithmic. That's in the last 9 years. You've seen basis, you've seen other ones, come and go, and there's just, as you alluded to, I think Zach, you said, and Jackie said too, it's like what we see today is not what we're going to have in the next 5 to 10 years. There's going to be other iterations. I hope founders understand the bodies that have been laid out there, like Basis and others out there that have tried these things and have not done them well. So I hope that's what we see in the future. But thinking again into the future, and we'll start from the back. We'll start with Jack, and then we'll move this way. What do you see the pathway for stablecoins to reach a $3 trillion market cap?
Yeah, I think I think too many people in our space brings a Web 2 mentality into Web 3, right? It's not about competition, it's about collaboration. So just like we talked about, we want all of these different stable coins to exist because they're addressing a different target audience. You're throwing things on the wall and see what sticks. And if it sticks, great. There's an ebb and flow in the macro sense of some things that fail and catastrophically takes us 2 steps back, right? Whether it's UST with the banking collapse and all the brokerages and exchanges and TradFi firms like Gemini and Galaxy, and the infrastructure providers such as Wire. I was first employee at Wire, where I was hanging out with the Prime Trust guys last night at our launch party. There's a little bit of group therapy there, right? Because there's so many of us that were trying to do the right thing, and then suddenly we just all collapsed. And then Bridge is doing God's work today, because literally Bridge is one of the only infrastructure as a service providers left that doesn't charge you an arm and a leg to use them, right? You've raised 2.5 mil as a startup developer, fintech application, and you got to pay $250K to other providers, right? Go to Bridge and use them to build out the next generation of the fintech applications. So, I think seriously, right? So like, in order to go from right now we're at 150 billion, right? In order to go to that 3 trillion, I do believe that we have to back the developers, right? And we have to kind of bring the informal economy of how USDT is currently being used in terms of cross-border merchant settlements into the formal economy, right? Nobody talks about this in terms of the under-discussed topic of how Tether's go-to-market actually came up, right? They only added Ethereum in 2018. Well, they were born in 2016, so who was using them? Well, there was a bunch of OGs in China and businessmen who were trading on the top 3 exchanges there, on BTCC and Huobi and OKCoin, that's realized, oh, cool, there's this new thing called U, right? They don't call it USDT, they call it U, right? So now I'll go from B to U, and I'm trading not BTC, but USDT. And if I'm a businessman, I'm starting to do different, business. I have trade partners in Korea, in Japan, in, Vietnam, in Nigeria. Suddenly, there's a network effect amongst my merchant network as a businessman, and suddenly everybody has a crypto wallet now. They're using the local, MetaMask version in Asia, right? Whatever it might be. And that's how USDT actually came up in a major way. It was like cross-border payments from China to the rest of the world. And that is an informal economy that can be formalized and streamlined in businesses. I think we go to 3 trillion by coming back down to the real world economy and helping merchants and helping developers to build the next generation of apps.
Yeah, I first thank you. I agree with all of that. I think it is reaching 3 trillion is I think inevitable over a given a long enough time horizon. So then the question in my mind is how to pull it forward, 5 years, or how to pull it forward to 3 years or what have you. The biggest, the most obvious thing in our mind is regulatory clarity. Regulatory clarity in the EU and in the US. And that the overwhelming majority of capital sits in entities that are regulated in some way, shape, or form, and it's very hard for them to hold stablecoins now, given that it's unclear what happens when things go south, or unclear how they can treat this asset from an accounting perspective, or unclear whether the regulators will even allow them to touch this. So that's probably the single biggest lever that would accelerate going from where we are today to 3 trillion, in my mind.
What is it?
For me, I think about the users. I think about what I mentioned earlier, that in order for people to really adopt stablecoins, they need to be able to use it easier. So they don't need to have to worry about setting up a wallet, managing their seed phrases. I think this goes to what Jack mentioned. We need to continue to support our builders so that they can build better user-friendly products on top of blockchains that are efficient, that can manage all of the volumes that we're hoping stablecoins can replace. So I'll keep it short and sweet there.
I'm going to preface this that this is my personal view and not the view of PayPal, but
Oh, I love this. This is good.
because I just speak, this is what I think. But so obviously you saw that PayPal launched on Solana. Just you think about what PayPal does, right? They abstract payments, at least a portion of them, away from banks, right? So they create an ecosystem where you can take some fiat, you move it into PayPal's ecosystem, and then 2 people in PayPal could pay each other without having to go to a bank, right? Now you take this up to one more layer and you put it on a blockchain, and so let's say PayPal abstracts 10% of transactions that would go to a bank. Once this innovation continues to deepen and move more and more on chain, because the cost and the speed and eventually the compliance will be at the speed in which, because compliance is what really slows down money movements. Like, you know, SWIFT is not slow because the electronic payment can't make it there in 30 seconds. It's because of the compliance checks along the way. But once you bring all of those transactions, now only 10% are actually hitting banks because we've created this network on one of the largest payments companies, and it won't just be PayPal. But I think that's how we get there, and I actually think it's a lot quicker than many people think. Like if you haven't used some of these payments apps that have stablecoins embedded in them, and you saw MasterCard launch their new kind of exchange payments platform, I don't think we're that far away. Definitely not a decade away.
Yeah, and I would say that to your point about compliance and that being one of the cogs there, I think that's also another reason why, as an externality to stablecoins, that decentralized identity and personalities are so incredibly important. Having the ability to have an on-chain identity that quickly can KYC AML yourself, that is universally accepted, is something that I think could have a massive effect on that as well too, and get into 3 trillion really quick. But that's something that a lot of different projects are working on. But at the end of the day, I firmly believe that the way that we get there, and Louisa said it as well too, is that you abstract the complexities away. I've been around since around 2015, 2016. I remember trying to do wallets, trying to remember seed phrases, all the complexities, and then God help you if you wanted to off-ramp it, it would be about 12 different steps. And luckily we have a few companies in our portfolio that have actually abstracted that away to 2 steps using omnibus channel technology. And so being able to get out, in our opinion, and our founder really said this quite brilliantly, is it builds trust. You can't just keep your users in. You have to have a mechanism that's easy for them to also get out. And so again, to your point, Louisa, about the abstraction away of complexities, it's not just account abstraction, it's not just using Web 2 or zero auth to be able to get in, it's also letting them to get out very easily too, and that builds that trust. But Zach, you talked about regulation, you alluded to that, and Joshua just before from Blockchain Capital just alluded to this well too. We've had a lot of movement in the last few weeks about US regulatory issues. We've had SAB 121, we've had FIT 21, we've seen some massive changes in sentiment. A certain person who is running for president again a few weeks ago decided to say that he was pro-crypto, and all of a sudden you've seen a huge sentiment shift in some of the regulatory burden that's happened. And so, Anthony, starting with you, what do you think the impact of regulation is going to be if it eases here? What do you think it's going to be? What kind of effect is it going to have on stablecoins?
It's a great question. Again, this is my own opinion. I think 2 things. One, I thought the Biden administration was going to loosen up on crypto post-election. I think they thought that it was a good lever, and then they kind of learned that it wasn't pretty quickly. And it makes you just understand how sensitive, how close this race really is to do that type of a flip. I mean, to be honest, SAB 121 was a complete joke in the first place. And all it did was keep Bank of New York out of being a custodian versus Coinbase, right? So, I think the SAB 121 and FIT 21 are going to make traditional players much more competitive. Mm-hmm. Most of these guys don't know which end is up in crypto, so I don't think it's going to happen tomorrow. There's very few that kind of get it, especially on the banking side. So I think it's a momentum shift that was happened just for SAB 121. Corporate treasuries can now hold crypto and be able to market to market, which they couldn't before, so it's much more capital efficient. But I think, don't get lulled into complacency, because FIT 21 is terrible for DeFi and is almost as restrictive in certain areas as MiCA is. And that's fine, because Europe is not really that innovative and there's not that much capital there compared to the US. But that's why I said this is my own opinion.
That's your own opinion. Okay, we'll just make sure that, again.
Putting MiCA standards on the US we shouldn't be cheering too much. We should hope that it gets amended very heavily in the Senate and then passed, or even fails in the Senate in this current form.
Or we at least have a starting point, which we haven't.
Correct. Listen, I think for centralized exchanges and certain things, it's fine.
Yeah.
They should just make it more of a sandbox on things they don't understand, specifically DeFi.
Louisa?
I'm not going to have too much to add here. I'm Canadian, don't have a direct dog in this fight, but I'm paying very close attention to it. My limited knowledge is I believe the FIT 21, it's not stablecoins related, but we are encouraged to see that they're doing something. The regulators are doing something about it, and we're waiting with hopes that there will be more clarity around the stablecoins front, but I will pass along to the other Americans.
I agree on the prior bills. I mean, I think for us the most top of mind issue is stablecoin regulation, specific stablecoin regulation, which has kind of gone in fits and starts through the House and Congress. And then specifically for us, whether stablecoins are regulated at a state level, like banks, or at a federal level, also like some banks. And that heavily dictates who will then be able to issue stablecoins, whether it will just be, the federally regulated banks like JP Morgan and Bank of America, the bank holding companies, or whether anybody, across the states will be able to issue stablecoins. And that determination will have a very material impact on what happens to stablecoins in the US. Because if you only have bank holding companies issue stablecoins, then you're only going to have a few. Most of them will be on private blockchains, and then maybe you have like PYUSD and USDC who go through the requirements to actually become a bank holding company. I'm guessing most of us in this room hope that in some way that there is a state path to issuing stablecoins in the US.
Yeah, I think U.S. definitely is raining on the parade of the world in that sense, right? There's a worse timeline here that we should all be scared of, right? What you just said in terms of like private network, anything, right? I don't understand why that's still happening. It is simply the incorrect architecture, right? There's public networks and public permission networks that are compatible with public networks, but why is anybody building private networks? It's like you're trying to build an internet company on an intranet. It's like nobody cares about your little intranet. So, like, anyways, like it is definitely possible for that to happen, though, right? Like that's the worst nightmare. It's like the Central Bank of China issues some kind of CNY, eCNY, U.S. issues, or through the banks, maybe not their own CBDC, but through the banks, some kind of bank coin, right? And now these private networks are talking to each other. And now that crowds out the public blockchain space. And we are all still on the fringe, and it's 15 years later, right? And you're all criminals, right? That literally, like, and that would be like the worst outcome. And let's try to at least steer away from that, right? In the here and now, let's just be pragmatic about it, right? There are regulatory clarity on a path forward, whether as in federal MSB or MTL, whether getting your own bank charter, at a state or, state level, you can get trust charters. There are proven models that works. We are in this kind of macro transition. We haven't crossed the chasm into something else yet. So there are clear regulatory models that work for you to continue scaling, even though, we're in this kind of multipolar world transition and, it's election year and it's kind of scary, right? I think regulation is definitely reigning on the world, from the US specifically.
All right.
Yeah.
And so the last question we're going to address is you have, effectively 3 different buckets of users of stablecoins. You have the institutions, you have the retail, and then you have enterprises. And so how do you think they all kind of compare to each other, between, as I said, the enterprises, the institutional, and the retail users of stablecoins? How do you think they compare or contrast?
Sorry, could I ask a clarification? How do you differentiate institution and enterprise?
Institutional would be more like the BlackRocks and the
Money managers?
money managers, RIAs, wealth managers, et cetera, et cetera.
And enterprise is like,
Tesla.
okay.
I think the enterprises will use stablecoins to break the dependency on credit cards. I think credit cards really only have 2 business models. One is to take an onerous fee to move money around, and 2 is to run a really shitty bad debt portfolio, right? So I think once they lose the revenue from that piece, so I think enterprises, if they can step in the middle of that 3% or 2%, I think that's a massive opportunity for them. I think institutions, and I disagree a little bit, my panelist members, that I think the banks will create a private network where securities will settle, just like they have right now, so that the Fed can keep a purview on that. But I think the opportunity set is stablecoins will enable T0 settlement, so every transaction can settle. And so you've heard people talk about this T0 settlement. Well, what it really means is banks hold 20 to 30% of their capital just for unsettled trades, right? So I trade with you and you trade with me, it could be the same exact thing, but until it goes through the clearinghouse, we both have to put up capital.
Yep.
By eliminating, and I'm not saying stablecoins is the only solution, but is a path to getting to that solution. Once we do that, the amount of capital that's freed from banks is tremendous, and you'll start to see banks that trade typically below book value trading at multiples. So that's like a from a P&L event or an investment event is pretty massive. I think for retail, it really comes down to education. I mean, I move money to friends. I have friends all over the world, and it's so much easier to just send USDC to their wallet to pay for stuff or like to chip in on gifts and things like that. That I'm going to go back to Louisa because she made the best point of the day. The abstraction piece is the killer app of the killer app.
I will build up on that. And from those 3 categories, I still think the most important group is the users, the retail users. To be able to drive further adoption, at the end of the day, when the institutions and the enterprise start seeing that users are adopting it and are actually moving money off-chain to on-chain, then they see the reason for them to actually change their legacy infrastructure to drive the real reasons behind why we're all here today, which is the underlying technology that supports stable coins to be issued on, full stop. So I would focus on users and how do we improve user experience when it comes to using stable coins, crypto in general, and hopefully that will lead to the other things. And one minor disagreement I have with you on the credit card companies, I wouldn't shortchange them. I think some of them are trying to be innovative and are doing things with blockchain and protocols in order to not be obsolete, to your point. And I think they see that, and I think some of them are trying to be proactive and not becoming obsolete.
Yeah, I agree with that. I mean, I think for enterprises and for consumers, to the point that you made, like abstracting away the complexities of using a stablecoin in whatever form. So, building on top of a stablecoin and making it feel like a Revolut, but, for folks in Argentina, is a meaningfully better experience than, signing up and getting a MetaMask wallet and then somehow acquiring USDC. If your use case is saving. And so, and the same thing is true for enterprises. Like enterprises, there isn't someone sitting in an enterprise that is like, hey, I want to do stablecoin payments so that I can log into my Coinbase account and sweat for 30 minutes because I may have input the wrong thing and totally screwed up this company and then have to deal with accounting and feed it back in. It's nobody, folks don't want to deal with that. That's a huge, so for the consumer side and for the enterprise side, the smoothing away, the many rough edges of using a stablecoin is probably the biggest thing. On the institutional side, they're likely leading the way because a lot of the benefits, there's a higher, we've seen there's a higher willingness to overcome those because the benefits of faster settlement or cheaper payments are immediately there. And then there's obviously lots of flow already happening, especially on the trading piece.
Yeah, I'm bullish on all three, right? It's like if you're an institution, Bitcoin ETF, Ether ETF, if you're Agora USD and you're using wire transfers to mint and burn, that's great. If you're an enterprise and you start using stablecoins as part of your payment flows and you're using SEPA or SPAY and PIX and other local banking rails to mint and burn, then that's great. If you're a retail user, now you have account abstraction, right? I call this payment abstraction as far as what Zach is building, which is kind of white label APIs for developers to build the next generation of applications for retail users to go and use this app. That's all great, right? From my perspective, it's just about connectivity between the payment networks, and that should not be different whether it's a private network or a public network. It should just be connected, and so that is free access, right? $1 should be able to move across all of these different networks freely, and hopefully cheaply. And yeah, that's how we grow.
Awesome. I don't think we have time for questions, but again, I wanted to thank the folks at Istari Ventures and thank you all for joining us today. Thanks to this amazing panel and talking about all the things happening in the stablecoin world, and we'll be seeing you guys. Thanks.
Thank you.